All right. Well, welcome on board to all of our attendees there. I can see you all popping in as we speak. I think we're just after 12:30, so maybe we'll get this show on the road. So firstly, I just want to say an absolutely massive thanks for coming along today. This topic of nailing the strategy of growth through acquisition is a topic that's really close to my heart, having worked on hundreds of exits and acquisitions. There's so much potential in being able to grow an organisation through acquisitions, but the strategy is critically important to making an acquisition a success. And that's really why today we've come together to talk about nailing the strategy of growth through acquisition. Now, first I want to acknowledge that we've got quite a few people on this webinar today, which is great news. Good that we're able to reach so many people, but we've got a variety of breadths of experience in the area of acquisitions. So what we're going to try to do is we're going to try to target the content today a little bit to each of you. So just so you know, we're targeting quite a bit of a cross section here. And look, we've received lots of questions in the lead up to this session, which is absolutely fabulous. We can see what you're thinking, what you, the sort of content that you want to hear about. But because we had so many questions, we're not going to be able to answer absolutely everything. So bear with us. We've got a lot of information in this webinar, and due to time restrictions, we really have to keep things at a reasonably high level. But having said that, feel free to add more in the chat. We've got a chat function running at the moment, so feel free to add questions in the chat. We'll try to answer them, but if we can't answer them in the webinar today, we might hang around for a bit afterwards with our fabulous panel, or if not, then we might reach out to you personally. And if we haven't answered your question, you'd like to be asked to do that, then we'll give you ways that you can contact each of us personally so that we can answer them. So that's it for the introduction. I guess now probably makes sense if we'll give you a brief intro of who we are so you know who you're listening to today. So my name is Joanna Oakey. I'm the Managing Director of Aspect Legal, and we are commercial lawyers, but we specialise in driving great deals in acquisitions and exits. And I also host Australia's top podcast in this area of mergers and acquisitions, the Deal Room podcast. And I'll throw over now to Simon and Nick to give themselves all a bit of an intro too. Simon, over to you.
Thanks, Joanna. Yes, so Simon Bedard, I'm the Managing Director of Exit Advisory Group. So we are a licensed business brokerage. We handle business sales and acquisitions every day. So, you know, we've got a really good handle on what drives company value. And I guess the advisory side of things, we do a lot of stuff around exit planning, business valuations, even strategic planning to help people know how to get from where they are today to where they want to go, which certainly feeds very, very well into this subject today.
Brilliant, wonderful. And Nick, how about you give us a bit of an overview of you and Grow Capital?
Yeah, thanks, Joe and Simon. My name's Nick Wormald. I run a company called Grow Capital. We're a business finance company. We partner with Australian business owners, matching their needs to over 80 different lenders and arranging the finance required to unlock growth and financial freedom. So we work with a lot of business owners seeking to buy businesses. This is quite a popular sector at the moment, and looking forward to discussing it all with you.
Brilliant, excellent. So let's kick it off. I think that's a great point, Nick. Actually, there is no time like the present to be looking for acquisition opportunities. So I think you've joined us at the right time to be looking at this. And Simon, maybe you can take us through these key stages of business acquisition.
Yeah, absolutely. So as you said before, Joanna, I think it was really great getting all the questions. We really had a pile of really great stuff there that we've really just tried to, I guess, consolidate, and so we can answer as many as we possibly can. And those questions primarily do fall into three real categories if you're thinking about acquiring a business, and that is the plan, engage, and complete. So If you think about the planning phase, it's really all about getting clear on your objectives, understanding how to create a strategy, and what sort of, I guess, defining the goals that you're really trying to achieve. The engage phase is about understanding who is your actual target market, and really how to go and find those prospective vendors. I think one of the big questions on most people's minds was actually, how do I find the right opportunities? And so we're going to talk you through some really good strategies on how you can do that. And finally, the complete stage, which is all about, how do you value a business, and what does that process look like once you've found a business that you really like and you think you want to acquire? So with that in mind, one of the first big questions that really came up for us was, how do you know when you should perhaps build versus buy? Because if you think about it, what we're talking about here is growing your business, right? And I guess in its most simple terms, there are those two levers, do I buy it or do I build it? And really, I think, like many business challenges, it comes down to three things, and that is the time, team, and money aspects in your business. So if you think about a typical organic growth strategy, generally speaking, it does take a fair bit of time. You do need to hire the right people. And of course, you need to invest in that strategy, whether it's marketing, sales, systems, process, etc. The difference, I think, here when you're looking to buy a business, you're still going to spend time and money and you still need a team, but it's the variables that change. So, for example, you will spend likely more money up front. However, you automatically do usually acquire a bunch of clients and additional money. You also usually get a team that comes with it. And so it's about actually compressing the time to achieve the growth you want. So that's probably one of the biggest factors that I guess we see with most business owners is they're looking to accelerate that growth journey. And if that's an important objective to you, then growth through acquisitions is something you should definitely be considering.
Yeah, fabulous. And actually, maybe now's a really good time for us to throw a bit of a poll in. So, question to you, our audience: what type of acquisition are you considering? Let's see if I can actually launch this poll. Here we go. All right, go for it. The timer has started. Don't be shy. Are you looking to acquire to grow an existing business? Are you acquiring a new business for the next stage, or are you acquiring a business to replace a job?
And just so you know too, when we'll be collecting all this poll data, we've got a couple of different little polls through this session, and some of the interesting findings we get out of it we'll certainly be sharing post this session as well.
Brilliant. Okay. Well, that's interesting. We have a really high proportion of listeners today who are looking to acquire to grow an existing business, which is great because that's what we're talking about today. So that fits in just perfectly. Good work. Okay. Ending the poll. Perfect. Okay. So of course, it's one thing to have in mind this idea of the benefit of acquiring for growth. The other thing, and perhaps the most important thing, is to be able to act on the idea and actually make it a success. And for that, planning is absolutely imperative, or in the words of Benjamin Franklin, if you fail to plan, you're planning to fail. And nowhere is this more true, I think, in the world of acquisitions, business acquisitions. So the Harvard Business Review has reported the failure rate for M&A at around about somewhere between 70 to 90%. And now I think it's really important to bear in mind that these sorts of statistics are probably a bit more skewed to the larger M&A deals. But, and, you know, in my own experience, I see the failure rate as far lower than this. But I think one of the most important things to take from this type of statistic is the reality that just having the idea to acquire for growth is not going to just in and of itself achieve its outcome unless you're conducting the right planning in advance, which is exactly why we have put together this webinar today. So what does failure look like and why is there failure? So I've put together some ideas of where I have seen the biggest issues occur in the past, and failure can be right up front. I guess number one, failing to reach a deal. You can spend a lot of time and money on trying to get through an acquisition, but fail to reach a deal at the end of the day if you haven't properly planned in the beginning and you don't know what you're looking for. The lack of industry or business knowledge is another critical issue that I have seen arise. And this is because quite often growth through acquisition is to build on new types of industries or product or service sets, but approaching it without having industry or business knowledge in that area really can create massive issues. Often it's just that the reality doesn't meet the dream because there's not been enough planning, or one of the killers is insufficient due diligence. So what I mean by that, and we'll talk about due diligence a little bit later on, but effectively we're talking here about the issues caused by overlooking the risks, because acquisitions can end up being quite an emotional process, and you can really get caught up in deal fever and start to overlook some of the important elements of what the business that you're analysing if you don't, number one, have the right planning and strategy in place, or number two, you don't have the right deal team around you to look out for those risks on your behalf when maybe you're in the height of your deal fever. Also, the other issues that we'll cover a little bit later, very quickly when we're talking about transition and integration, is failing to have the value that you're looking for in an acquisition transfer. So this can be in all sorts of value that you might be looking for in an acquisition, but in particular can reflect in clients not transitioning properly, or staff or key suppliers. And finally, the lack of clear strategy. So here we're talking about being really absolutely clear right from the beginning on what you want and what that looks like.
Awesome. And that really leads into that next slide as to, you know, one of the common questions we got was, how do you best identify strategic objectives before acquiring? And so there's really a couple of questions that you need to ask yourself, and we'll touch on each one of these individually in a moment, but looking through, you know, what type of acquisition are you looking for? What is your end game? And you know, there's an old saying in this business that, you know, the best time to think of your exit strategy is actually before you start the business. So unfortunately, all too often we see people don't actually think about their exit strategy until one day they decide that they've had enough and they want out. And that really limits your opportunities to do anything valuable with that business. So understanding your end game, and then really matching the market opportunities to fit your criteria. So let's dive into these questions individually. What type of acquisition are you looking for? Well, really, and this was, I guess, fleshed out in that first poll, is, are you looking for some sort of a strategic bolt-on where you're growing an existing business, or are you looking for a new venture? And that question is really important, not just from a clarity perspective, but it really informs the next stages of that process. You know, what type of opportunities are you looking for? How do you go about finding them? And then ultimately, how do you engage them? Because the strategy does vary at each of those levels. The next question is, what is your end game? And what we've tried to do here is just really throw up some broad topics for you to consider, because once again, most people don't think about this stuff until they're so deep into their business that they're really committed to certain pathways. And I think for any business owner, you know, we know that business is risky, the markets are risky, everything changes, COVID's demonstrated that. You know, ultimately for all of us, we want to keep our options open. We want to understand that when we get further down the track, you know, whether it's 5, 10 years, wherever it might be that you may want to exit, that you've still got a range of different options available to you that you can execute on, especially given life and business circumstances change so often. So just look through those. You know, what are you looking for? A lifestyle business? Are you looking for, you know, a better work-life balance? What kind of exit options are you considering? You know, will you need to sell this business down the track? You know, I'm a massive advocate of building a saleable business. You know, even if you have no plans on selling it, it just happens to make your business usually more profitable and a lot more fun to run. So keeping those options open, you know, are you selling? Are you handing it down to your kids? Is valuation important to you? I've had many clients come to us where we valued their business, you know, delivered what the number was, and invariably it either meets their expectations or it doesn't. So, you know, do you have a number in mind? Is there a specific number you need to be able to retire or move on to your next venture? You know, and I would even challenge you to question the thinking that goes behind that valuation, because invariably, you know, it's a bit of a rule of thumb rather than people actually putting a little bit of math and science behind it. Of course, timing. You know, are you getting close to retirement age? Are you much younger than that and thinking about this as just your next stage of your business journey? And of course, finally, legacy. You know, I see a lot of businesses where, you know, the family name's on the door. There are family and friends working in the business, and how that brand, employees and people are managed going forward is critically important to those owners. To others, not so much. To others, it's just hey, you know, I've sold the business, it's yours now, do what you want. But, you know, everybody takes a different view to business ownership and what legacy and what many of these variables mean to them. And, you know, I just encourage you to be thinking about that stuff up front before you start committing to a strategy and spending money. The final question, what market opportunities fit your criteria? Now, you can see a checklist over the side. There's a bunch of things that, you know, you need to be thinking about, and some of this will align with your own experience and skills. You know, what industries are you looking for? What geographies? You know, business models. You know, one of the big things that we see out there at the moment is this push for recurring revenues, and we can talk a little bit more about that as it impacts valuation as well. But you know, what size are you looking for? You know, and I guess that will feed very much into Nick's talk on funding. You know, what can you afford to buy? But either way, with all of these sort of questions, what I'm challenging you to do is think about that graph on the left there. It's very much a three-dimensional graph of your market. And, you know, when you start thinking about what a strategic acquisition looks like, you can start to understand, especially when you're buying to grow an existing business. You know, you look at that vertical line there, you know, suppliers right through to customers is your vertical industry chain. Now, when I worked in the solar industry, just to give you a good example of an acquisition strategy around this, the company I worked with at the time managed raw materials right through from, you know, we did solar panels, right through from raw materials to creating ingots to creating solar panels, and we wholesaled those panels globally. But ultimately, we were trying to get closer to the customer to increase margin. And so to that end, we started launching new sales channels and we started going direct to market. And in the end, we not only acquired a number of businesses in the retail space, but we ended up acquiring a large stake of a retailer so that we had an ongoing existing relationship with customers and managing their electricity accounts. So you can just sort of see, I guess there's just a simple example of how you can either vertically integrate upstream or downstream to help drive more value into your business. Out on that horizontal line, you're seeing obviously competitors, and if you're right in the middle of that graph, you may have, you know, competitors out to the left might be based on products, and out to the right could be based on services. Either way, what you're looking for is something that's going to complement your business. And another good example of that is we sold a water engineering firm last year. We sold it to an ASX listed business that fundamentally our client was really the biggest pain in the butt to these big, larger company. They were smaller, more nimble, could always undercut them in pricing. When the acquirer, this ASX business, bought them, not only did they take out their biggest competitor, they acquired a much bigger market share. They also then massively reduced the tension around pricing in the market. And literally, there was a memo that went out to all of their offices about a week after the acquisition was finalized, where they told the entire company to put up prices by 15%. Now, what a wonderful way to acquire or pay for that growth. And so the payback on that was around 12 months in the end. So it was a fabulous deal for everybody. Finally, if you think three-dimensionally on that sort of Z-axis out there, you know, we're talking about complementary businesses. And I guess the most simple example of that I can give you is, let's just say for a moment you manufacture tables and down the road there's a guy who manufactures chairs. Now, you don't buy and sell from each other or to each other in that vertical chain. You're not competing with each other, but geez, there's a lot of synergy there, right? So it would make a lot of sense for one of those companies to acquire the other one. And I guess really what I'm saying to all of you is have a real think about your business through that sort of three-dimensional lens and think about what opportunities out there may exist for you. And then overlay the filters over on the right there around industries and geography and size. And it'll help us start to map what would be a good acquisition opportunity for you. Now, just on that note, I think we actually have another quick poll we're going to throw out too.
Let's do it. These polls are exciting. I'm enjoying them. Let's launch this other one. So where are you at in your acquisition journey? Here we go. Go for it. You're looking to acquire something in the next 12 months? Are you looking to acquire something in the next, 1 to 2 years? Or are you an advisor and you're looking to advise other businesses for acquisitions? Brilliant. I love how responsive you all are. Thank you. Looks like there's a lot of people out here who are looking to acquire quickly. So that's great.
And I think it makes a lot of sense given, I think one of the big questions we get at the moment, Joan, I'm sure you're probably the same, is that, with COVID and all the things that are going on in the market, I think anytime there's volatility, entrepreneurs see opportunity. Right. Yeah. And I think if you've got some dry powder, if your company's got a strong footing and you're confident about the future, then yeah, look, there are opportunities out there. And I think there's a lot of people sort of seizing on that at the moment.
I think you're absolutely right. And it would be wrong for us, I guess, to move past this webinar without talking, very quickly and highlighting the fact that, I think we're sitting in a period where a lot of opportunity is about to open up. But the whole point of talking about the subject that we're talking about today is how do you get yourself best prepared for that so that you can pounce, because it will be, I think, I feel very strongly that it will be the kind of market that favors fast movers. So you have to be ready to move fast. So you need to be answering these questions now, even if you feel you're not ready to go for another couple of months. Otherwise you'll see deals passing you by. And in fact, right at this moment, we're seeing a lot of activity, but we're also seeing things snapped up very quickly. We're seeing a seller's market right at this point. It might change in the next few months, but you just have to be ready to go. And I guess that's why we're having this discussion today.
Yeah, absolutely. I think that's a really good point. I mean, understanding what can you afford to acquire? What sort of funding have you got behind you? But and I think we touch on this later, is actually having a team around you that will enable you to run multiple processes in tandem. Because if you can't do that, you're going to struggle to keep up with those who can. Yep. So, and on that note, we might hand over to Nick to talk a little bit about funding.
Thanks, guys. And great info, Simon and Joe. It's educational even for me. We go through this process quite often with clients. So it's, look, I just wanted to start off in the real basics of finance. So that, look, people come to us all the time and ask the question, how much can I borrow? Can I borrow? Can I buy this business? And the question's quite complex. It's not such an easy answer. So I usually start with these, with the basics, and the basics of credit or borrowing money or loans, or if you're going to someone that's going to lend you money to do something, you need to have all of these 5 boxes ticked. First box is character, and this is really important. Going back to what Simon was talking about a little earlier about buying a business that isn't in the same sector that you're in now, you need to prove to that lender that your character is sufficient to, can you manage that business? Do you know how those businesses operate? Have you run a business before? Or you're working in a PAYG sort of situation. So it's really important that your character is clean, and not about who you are, but about can you execute, can you do the job. running a business, which isn't easy. Number two, we've got capacity. And this is quite a black or white, quite a simple, it's more of a calculation, should we say. So that is the target business that you're buying, does it have the capacity to repay the debt? So we talk about interest cover. There's a whole heap of ways of looking at whether that business can afford to pay down the debt to buy itself, or whether it needs other functions outside of itself, whether there's other businesses securing this business or however it may be. It can get very complex, but the basic premise is capacity is the ability to repay the loan. The next segment we have is capital, and this is the cash. So when you buy a house, you need a 20% deposit. When you buy a business, generally you need money. You need money up front. So sometimes this comes in the way of equity from property or cash or shares, or it can take many different forms. And once again, it's a complex space, and that's where we can help you. So moving on to collateral, this is an interesting one, and I get questioned about this quite often. Is lenders will generally lend money to people that have property and behind them, so they have collateral behind them. And the reason being is it mitigates a few things, one of which is flight risk. You know, you're not going to borrow $3 million to buy a business and then it doesn't work, so you nick off back to Brazil, or it ties you down and shows evidence. It sort of loops back to character as well. Evidences that you have the character to borrow money and to repay debt over a term. And the fifth segment is conditions. So, are you clear on the conditions of the loan? Are you happy with the conditions of the loan? And it's a piece of the puzzle that comes, I guess, at the very end when you've got a few different lenders that have got terms on the table when you select which one suits best. So they're the five basic core principles of borrowing money. You need to really tick all of those boxes to get through. So we've had a lot of questions around the loan process and how it differs from residential lending. And look, I've just laid this out. It's pretty basic workflow of the loan process for business acquisitions. It is similar to borrowing money for a tractor or a house or a warehouse, but there's a few extra steps which are key to the process. So we collect the information on the target business. You need to have quite a lot of detail on a business, and this goes back to the due diligence. So as part of the process, you will be doing your due diligence on that business. You'll be building a business plan, and you will be modeling what that business is going to look like and how it's going to perform, and forecasting the cash flow and all the other aspects of the business going forward. So when you come to borrow money, you should have a business plan, a model, and forecasting in place, because this is critical in that first step when you go to a lender. If you don't have this in place, they'll literally just put it aside and move on.
Yeah, it's worth mentioning, Nick, that business plan is when you go to sell your business, just as critical, right?
Yeah.
People coming in to buy your business, they actually want to see that you have a plan, that you know what you're doing. You've got some sort of forecast or understanding of where the business is going to go. So, such a critical item.
And 9 times out of 10, that's for the purchaser, so they don't need to redo the work. They can take a lot of the work and just tweak it. So yeah, it's very important.
Sorry, I just want to throw in here as well, because we're seeing lots of deals at the moment get delayed because of, obviously in COVID at the moment, we have some issues. And I think this step that you're talking about, Nick, is super important for reducing the likelihood and the length of a delay that financing can take, because there's a lot more comfort that financiers are after right at the moment to ensure that acquirers will be able to run the business successfully.
That's right. That's right. And you basically what you're doing is you're mitigating the risks up front. That's what we do in our business. It's all about mitigating the risks and sending those risks that are still left over to the right lender. Every deal has a different lender. It's quite a complex process. So that moves on to step 3, which is tendering. It's basically what happens is there's a tendering process where the all of the different lenders that would do a specific type of transaction because they all differ. You know, you might have a medical practice versus a trucking company. So the lenders that lend to those two different types of businesses are completely different. The pricing is completely different. So we would take a trucking company out and tender it to panel A. We would take a dental practice out and tender that out to panel B. So that's where we have 80 different lenders in our business. There's a lot of different options out there. Yeah. That panel comes back. We have terms from all the different lenders. Client selects a lender. The application's submitted based on all the information that we've already collated and collected. Then basically the application is submitted and it gets to a conditional approval. And this is kind of the point you really want to be at before you commit to the business purchase.
Yeah. It's one of the first questions we always ask, Nick, is, people come to, when we're on the sell side, people will come in and say they're interested. And it's one of the first questions we ask is how are you funded? To what level? How much are you borrowing? Has that been pre-approved? Because if you haven't got all that sort of stuff, to be honest, I'm not probably going to spend much time talking because you're not in a position to acquire.
No, you're not. No, it's vitally important. Some people do. They take the risk and they'll commit to the business. They'll commit to the purchase, knowing that because they've been through the lending process many times and they know that they can get the money. But it's never recommended by us. It's always have that pre-approval in place. So once that's in place, then all of the teams engaged and all the outstanding conditions are ticked off, and the loan goes to a formal approval. Loan documents go out, and it moves to settlement, which is the important part, because that's where the business moves into your name.
And Nick, one other thing, and I'm sure you're seeing this yourself, but we've certainly seen a few transactions at the moment where the business involved brought in goods, particularly manufactured out of China. And certainly we've seen financiers at the moment doing COVID checks. How is COVID impacting your supply chain, and can that impact the ability for the business to survive?
Absolutely. So there's a lot of COVID checks. In fact, most of the prime lenders will have a declaration up front from, if you have a broker, from the broker and the client, confirming that that COVID, not that COVID hasn't impacted the business, but how it's impacted it, because it's been pretty much every business. So a lot of clients fill out those forms, and COVID's actually improved our business. We're up 25% over the last 3 months.
So, funnily enough, we saw that in our examples as well, where they're selling products that actually fit well for people who are in lockdown.
Yep, absolutely. Look, COVID's been great for some business owners, because it's provided opportunity. A lot of people just have exited. They've just wanted to exit companies because they don't want to run a business anymore, too risky. And there's opportunities for their suppliers or the customers or competitors. It's amazing the volume of business purchases we're seeing at the moment is staggering.
Awesome.
Yeah. So we're going to just stop onto the next slide. So, all right. So I'm just going to go through. This was another question we had. Just some typical types of security that people use for business acquisitions. So, look, property's the gold standard. That opens you up to the major banks, really, at the end of the day. If you've got a $25 million unencumbered warehouse, then buying a supermarket for 25 million is going to be pretty straightforward. Not many people have unencumbered property, unless they're incredibly wealthy. Hence the major banks don't get a whole heap of transactions these days. What we generally see is, the client might have a home, maybe an investment property, a couple of $100,000 worth of equity in each, and it's used to kind of help bolster the application. It's not generally used as security, but it's maybe a second mortgage. The main things that we see with securing business purchases are plant and equipment. You might be a big manufacturing plant, or trucking companies, another example, where there's a large, strong balance sheet. When you buy a business, generally you'll be buying unencumbered assets. So when you buy the business and it's got 25 trucks, those should come unencumbered, and therefore you can use them to help secure the finance. So the next one is intangible company assets, and this is an interesting one. It's something that is pretty unknown out there. Securing against IP, contracts, forward contracts, shares, securing against receivables, which is a huge play in the invoice finance space. That's basically the security of all of the receivables on the receivables ledger. So any money owed to the business is something that can be secured against. GSAs over the entire company, which is basically ownership of the company, are some of the intangible assets. So we've done a few large transactions that have had no plant and equipment, they've had no property, and it's all been based on forward contracts, government contracts, cash flow, IP. So there's a lot of there's been a lot of questions around that. How do you fund something that doesn't have physical assets? It can be done. It's difficult, but it can be done. And also there's a combination of the above. There might be $1 million worth of plant, and they've got some IP around that plant, and they've got a little bit of property, and those deals are typically the strongest. The lenders like to see a little bit of security. Brings the rates down as well.
Sorry, mate. And for the non-industry people, what's a GSA?
A GSA is a charge over the business. Basically, it's like a mortgage that a lender takes over the business. So it could be in the form of a PPSR or an all-PAPS. There's a whole heap of different names and acronyms in the industry, but basically it's a charge over the business. So if you default on your loan, the lender's going to come and take the security. So if you default on your loan and you have a GSA, then the lender will that basically takes control of the company, and it's a form of security and a really valid form of security. In fact, if you're looking at corporate banking, like high level banking, where you're turning over $1 billion and you're going to NAB for a $250 million loan, typically that's a GSA that will secure something like that. So it's only on the small end of the scale that the banks want property.
Excellent. And typical finance types?
Okay, so look, finance types, 9 times out of 10 is going to be a term loan. You're going to borrow, $5 million, and you're going to pay that back amortized over 5 years, interest only. That's sort of general typical type. Asset finance comes into play when you have assets in the business. So typically, the asset finance is secured against the actual assets. So you have a term loan secured against the business. You might have a couple of trucks secured against the actual assets. And you might have some trader and debtor, some debtor finance secured against the receivables. And then there may be a little bit of vendor finance in there as well. So this was a question that was asked around vendor finance, and it's quite a big topic in itself. And probably a little bit out of scope on this webinar. But basically what it is where the vendor holds back some of the value or the sale price and they carry that. They stay involved in the business, or they don't stay involved in the business, but they basically lend a portion of the sale amount to the buyer.
And it's probably worth just mentioning too, I mean, I've seen so many different types of vendor financing arrangements. So, you know, there's no necessary sort of rule of thumb about how you do it. It really comes down to the individuals involved in the deal, what the business looks like, what assets are there, what the model looks like. It really is, you know, designing the right solution. And look, frankly, you just may find a vendor who's just not willing to lend the money. So, you know, it's such a unique proposition.
Yeah, it is, and it's really flexible. People freak out when we bring it up as an option, and generally, then once walk down the garden path, it's always a viable option, and it comes in so many different flavors. You could have a good lawyer, and you draft a contract based on everyone's agreements. It's pretty simple.
Yeah, and I'll just throw in there. One of the aspects of the you know, our business environment at the moment is that we're seeing a lot more vendor finance, or whether that's deferred payments, earnouts, that sort of you know, discussion at the moment, and most deals will contain some component of this, even if it's small. Yep. So, you know, it's definitely something that you'll need to get your head around, understanding the different options that are available for you to talk about and negotiate as part of the deal.
Absolutely. Absolutely. And it's look, sometimes it's actually used as a, you know, pseudo deposit. You know, if you get to the point where you haven't got enough cash to put into the transaction, and lender wants to see the vendor hold back some of that money. So it's viable, definitely a viable deposit option.
Well, and to give you guys just a quick example, so we've just been in the process of selling a company at the moment. The price is a solid 8 figures, and really we had 3 buyers at the table, and all of them in their offer proposed a really quite a detailed structure around paying something around 40% up front. There was about 40% to be paid in deferred increments over a 2 to 3 year period. That component was not at risk, so it was just deferred. And it also paid a small clip of a coupon for interest. And the final 20% was actually completely at risk. So it was a full earnout, dependent on certain criteria being hit. Now that's quite a common structure, certainly when you get to larger businesses.
Yep, we see that all the time. I would say that's probably the most common structure when it comes to vendor finance is an earnout with a deferred payment and a percentage up front. Yeah.
Cool.
So, look, this last slide we've got here is just some misconceptions that we get a lot of frequently asked questions, and this is just answering some of those FAQs that we get. The first one is the need to have property or real estate to purchase a business. So that's absolutely a misconception. You can do it. It's a lot simpler if you have property once as mentioned, but it can be done without real estate. The second misconception is that you can't borrow 100% of the purchase price, and this is also untrue. There's a lot of businesses that pass over our desk where the clients borrow 100% of the purchase price, particularly if that business has got some pretty large contracts and a strong balance sheet. That balance sheet goes into actually securing the business. So in theory, the asking price is 5 million and they're buying it for 5 million. That's 100% of the purchase price. Now there may be 20% of value in there on the balance sheet. So it's not technically 100% of the purchase price, but it is on paper, on face level.
And Nick, it's worth just mentioning here that kind of scenario. And I know we've got a number of accountants on the call today or on the webinar today. You know, that's the conversation to have with your accountant, who is a part of your deal team, right? So, you know, how you structure things going into this. You know, a lot of people are using, you know, discretionary or unit trusts and various different companies, and how you manage debt and effectively manage tax is a big consideration, right? So, you know, that may actually, you know, alter the way you want to approach your financing, yeah?
Yep, absolutely. Absolutely. Accountant's got to be involved. It's critical. And again, and just refreshing on that is that deal team is vitally important to have that in place up front. It's, all the successful transactions that we do they have a very close knit group of people that they lean on to do all of the professional work. So the third item here is about major banks, and only the major banks will lend money to businesses, and look, that's a question we get quite a lot, where people have been to the banks and they've all said no. So we've got 80 lenders on panel, ranging from the major banks right through to private funds, overseas investment funds, even private individuals. So there's a lot of different options. There's a lot of options out there outside of the banks. Of course, you'll pay more. The banks have an unlimited supply of free money, so they can have low rates, but generally you'll pay a lot more with investment funds, but they get the job done. Another misconception: lending has stopped due to COVID. This is definitely not the case. We've seen a threefold increase in lending since COVID hit, and it hasn't stopped. So there's a lot of lenders out there trying to get money out the door. So it's definitely worth coming and having a chat about this. And the last misconception is buying a business is the same as buying a property. It is more complex. There's a lot more due diligence that needs to go up front. It's although the general steps of the process are relatively similar, there's a lot more that goes into it.
Yeah, nobody ever walks into a business and says, "Ooh, I love the kitchen and bathroom. I just must pay a little bit extra to buy this place."
Yeah, that's it. That's it. It's always bargaining down.
Yeah, absolutely. Actually, just while we're talking finance here, you know, and you know, thinking about what your acquisition level is, I think we have one more poll question that goes with, and I think it's our final poll, isn't it,
We
Joanna?
do. Poll number 3, the lucky last. So here we go. Go for it. What sized acquisition are you looking at? If you can throw in here just a rough guide, just so we know, it helps us work out the things that will be of interest to you and not in the rest of these last 12 minutes.
No, we'll move on to that next slide while you're doing that, just in the interest of time. So while you're completing that, you know, we've touched on a few times now about having the right deal team. And look, I think, you know, I've sat on both sides of transactions, both buy and sell sides. I've sat outside of deals and just given advice. And the one thing that is, you know, consistent is that the deals that are the most successful are where the parties have a good deal team around them. They have good advisors, and good advisors don't just give good advice. They're also able to get things done. So when you talk about a typical transaction, you can see on there on the screen right now, there's a bit of a checklist here. You know, having some sort of an advisor, somebody who can manage the process for you. You know, negotiations can be tense, and frankly, if you're going to acquire a business, it's good to sort of stay out of the fray with some of that stuff, because really you're trying to preserve your relationship so that when the deal does go through, you're in a good standing to go and work with those people in a really proactive and positive manner. Besides that, there is a lot of work that goes into doing a business sale or acquisition. So there's a lot of back and forth. There's a lot of chasing things up. There's a lot of corralling of different parties. And so unless you're looking for a second day job, my recommendation is have someone close to you who can help do that heavy lifting. It goes without saying, you need a lawyer, and you need a lawyer who actually understands transactions. You know, the thing we've seen many times out there has been where somebody wants to use the family lawyer who perhaps has not really got any experience in this area. And whilst, you know, understanding the law is important, it's like sort of saying to a brain surgeon, you know, asking them, you know, can they do the same work as the podiatrist? I mean, they're both doctors, but really they focus on different areas. Same thing with your lawyers. You need a good commercial lawyer who gets transactions and understands how these things work and a lot of the nuances that are going to impact your deal. And trust me, you will have those nuances. An accountant, you know, this probably sounds like an absolute no-brainer, but you need an accountant who can do financial and tax due diligence, who can help you with your business modeling, your forecasts. They'll be engaging with your financiers. You know, having a solid accountant is critical. And, you know, if you don't have a solid accountant already, then certainly, you know, we recommend people. But at the end of the day, you know, we work really well with anybody's accountants because usually they're pretty switched on to what's going on to the client's business. Of course, a financier, you know, and you've just heard from Nick talking about the need to get your funding right, get aligned with people who know how to represent your business and go find you the right deal. And of course, finally, you know, we've sort of broadly terming this operations, but generally you need somebody internal, right? Once again, unless you're going to do absolutely everything, and I would suggest to you that that's not a good idea because you're going to have enough on your plate. You need somebody inside the tent, somebody internally who understands operations to help with either the integration or the transition, right? So if you're acquiring another business to bolt on, it's very much an integration, and you've got two companies with two lots of staff, two cultures, two sets of systems, rules, processes, all of it. There needs to be somebody who is masterminding that plan. And certainly if you're going out on a new venture, well, just the simple transition. How do you get in there, learn the people, learn what you need to know, and really get your hands into it before you sort of start making changes. So surround yourself with the right team. It's what actually gets deals done.
Yeah, and I just want to add to that because, of course, we're talking here about, you know, the end acquirer, the end buyer surrounding themselves with the right team. But we're also talking here, you know, we've got a number of advisors on the call. And I think just to add, you know, to some of the things that you're saying, Simon, for advisors to have professionals lined up that they can deal with, that they know have their back as well, is really super important. So if you're an advisor, but you don't do a lot of work in this space, then you need to line yourself up with you know, a deal team that you can use for your clients who are able to support you and who've been through the process lots of times before.
Absolutely. So moving on, some of the big questions we got asked was really about how do you go find the right opportunities? And I'll reach right back to one of our first slides where we said, well, what type of acquisition are you doing? If it's a bolt-on, well, that's going to have some certain particular sort of approaches about it. If this is just a new venture, probably, well, in some ways it's easier, in some ways it's harder. So let's look at the two different options here. First of all, you've got a bunch of online portals out there. So if you've ever acquired a business before, you'd be familiar with these. If not, look, it's pretty easy to find them, but there's lots of online websites from Seek Business to, you know, Domain, you know, a lot of different ones out there that you can use to look up and see what businesses are for sale. Now, of course, these portals don't cover the entire market, and yes, many transactions get done before they even go to market. That, I think, feeds back into having a deal team with people who have their finger on the pulse. But if you're looking for a specific opportunity, you can certainly create a profile on these portals. You can determine what kind of businesses you're looking for, from industry to geography to size, and really set up an email auto alert. So you'll just get emails in your inbox every day that'll tell you whether there's an opportunity that fits your criteria or not. Now, that's fabulous if you're looking for a broad new adventure and, you know, you don't necessarily want something, you know, a singular specific industry. These are great. You know, it can put lots of opportunities into your inbox. I'd also say the challenge around that is it can also throw a little bit of confusion in there because you'll get a lot of things thrown at you. So sort of sifting through can take a fair bit of time. So once again, be clear on what you want. And if you're industry agnostic, then get clear on the model and the size and the geography and those other elements. So online portals, they're fabulous. They do work. The other approach, and this is one that I'm a very, very big fan of because it is just so effective, is the direct approach. And I liken this to hunting with a rifle instead of a shotgun. You know, it is very, very targeted. It's very specific. It's definitely more labor intensive, but you get the results. And this is where and let's just say that you already have an existing business, you're looking for a bolt-on. You do a bit of market mapping like we showed on that 3D map. You start to decipher what kind of opportunities you're looking for. And then it's about, you know, identifying those businesses and having a plan to go and engage them. And interestingly, many opportunities out there, but people who have no process in place to sell their company, but if they get a knock on the door, they're absolutely interested. So the question then becomes, how do you sort of handle that direct approach? Because once again, I think most people have a day job. They're not looking for a second one. And if I can just give you a little bit of a structure around that, as you know, we've talked about the 3D map. Once you do the research, and most of this can be done online, you create a list of prospective businesses that meet your criteria around industry, geography, size, scope, etc. You then need to go and investigate who the appropriate people within those businesses to actually speak to. Of course, you then need to capture their contact details, and then you've got an outreach program where you literally are reaching out to these people and their companies and letting them know that you're interested, or inquiring about whether they're interested in talking about opportunities. So this sounds like it's labor intensive, because it is, but as I say, it is very, very effective. And if you are looking to bolt on a business to an existing one, this is the strategy that I think has the greatest chance of success. So, of course, once you find a particular business that you like, the big question is, of course, what's it worth? And, you know, that's the number one question I get asked all the time is, you know, hey, what's this thing worth? And, you know, the kind of frustrating answer I probably give too often is, well, it's worth what the market's willing to pay. But ultimately, there are methodologies you do need to consider. And ultimately, it's about as much setting your own expectations and awareness of the market as it is going out there and sort of engaging other parties. On the screen, you'll see a couple of different methodologies, you know, some fancy terminology here: capitalization of future maintainable earnings. It sounds like, you know, somebody with an interesting finance degree came up with a nice title to keep their job. Ultimately, that's typically just a multiple of your net profit. But if you think about it as capitalizing that net profit, those maintainable earnings. We'll talk a little bit more about that one in a minute. We do see a bit of discounted cash flow going on out there. Some really interesting models around that, particularly when you're a larger business. And of course, net tangible assets. So I think with COVID and a lot of businesses looking at potential liquidation, those net tangible asset methodology will be used a lot more in those cases. It's also a factor when you see companies with huge assets on the balance sheet. You know, you've got a big trucking company and a lot of earth moving equipment and stuff like that. Understanding, you know, what the business is worth from a net tangible asset perspective will be relevant. But as I say, look, the most common methodology is the first one, this capitalization of your future earnings. And that's really done by applying a multiple to your net profit. So net profit times a number gives you your valuation. Now, of course, there's a lot of questions that go around this. And, you know, the first one, of course, and I think for the accountants on the call, you know, you'll get where I'm coming from with this is, you know, what net profit are we actually using here, right? Because you get a lot of terminology thrown out there and, you know, are we using EBIT? Are we using EBITDA? Are we, you know, what does net profit mean? What are add backs? You know, and there's lots of different calculations that are involved in valuing or coming up with that specific number and making sure it's the right number for your business. So that's something that, you know, you definitely do need to speak to your accountant about, and also engaging advisors to understand, well, what are some of the common methodologies for a business like yours or businesses in your industry? Of course, the multiple. If any of you have ever done this sort of stuff before and you've bought businesses, I'm guaranteeing that you have heard somebody say, oh, hang on, you're in that industry. Well, you're roughly about a 2.5 to 3.5 times. Now, look, industry rule of thumbs have their place, okay? They do have their place. They've come about because a number of transactions have been done and they've ended up coming up with some sort of an average. But if that's all you're relying on is that thumb to the wind and a bit of an average, then you'll be doing yourself a grave disservice. Rules of thumb have their place, but they're a piece of the puzzle. They are not the whole picture. And look, I think if you consider it logically, a rule of thumb suggests that all businesses in an industry are actually the same, and we all know that that is not true. So what I would be suggesting to you is and certainly the method that we use to coming up with a multiple is to look at all of the non-financial elements within the business and even apply a qualitative assessment to the actual financials. That qualitative assessment of the business and all those non-financial elements inform that multiple for us. And that's why we've seen businesses in the same industry trade from anything from a 1 times up to an 8 times. In fact, you know, we've all heard stories of those businesses trading for 10, 20 times, etc. And I can share plenty of those on another webinar if you like. But yeah, look, you know, commonly we are seeing businesses trading at anything from sort of 1 to 6. And it really comes down to how good is that business? Now, yes, a lot of them might trade around that 3 to 4. What should you pay? Well, it comes down to the individual business and doing the work and doing the due diligence and understanding where value sits. Because let's be honest, if you're going to buy a business, you know, that business might be making $1 million in their hands, but when it bolts onto your business, you might turn that business into a $5 or a $10 million business fairly quickly. Now, that's not value you're going to pay the vendor for. That's your value. That's the value you bring to the table. But you need to understand where that sits and where the leverage is in that deal. So,
Brilliant.
Speaking of due diligence and doing the checks.
And look, just a quick note: we've hit 1:30 now, so we've sort of hit the end of our hour. We'll continue on for a few more minutes. We've got a few legal sides. In fact, I'll just whip through those in just a couple of quick minutes, and then we may or may not have time for some quick questions. What we will do, though, is we'll throw open the opportunity for you to ask questions. If you can't answer them today, we'll be sending around a survey after today's webinar, and in that survey we'll be asking you for what other information you'd like to hear about, and we will be providing that. I think there's a lot of legal issues that need to be considered, and we'll be offering that up in a future webinar, and there might be a whole heap of other things that you'd like to hear about. So stay tuned for that survey. We'll send that out, and we ask for your response on that. But let's just very quickly, in 1 minute each, whip through some of these questions that came up. All about the legal side of getting yourself ready as an acquirer. So firstly, business due diligence. Lots of acquirers are not entirely sure what they should be looking out for from due diligence. What is due diligence? How much time and money should they spend on it? And the answer to all of this depends really on the circumstances of what you're purchasing, but I see it in 3 really simple ways. Firstly, what is the value that you're looking at getting from your acquisition? How is that value protected? How will that value transfer? And what are the risks that you need to be aware of? So that's really what you're doing in the due diligence, both from a legal perspective and, as you can see here, looking in a detailed way at operations, technology, regulatory compliance, insurance, tax and accounting, and of course, as I said, legal as well. So then moving along to some questions about, we might just throw forward to the next slide here, about structuring the deal. We had lots of questions about structuring the deal. Once again, I think that it's best that we put this into a future webinar, because there's just so many decisions that can be made for structuring a deal. But the one message that I just want to get out to you today is that there's a lot of opportunities for different ways to cut deals. So you can look at mergers versus acquisitions. So that really depends on the size. Is your acquisition going to create a new entity where you're potentially acquiring or merging with another entity that's the same size or larger? Or is this an acquisition? Are you going to bring another organisation in and bolt it into your business? Is it going to be a full buyout or a partial buyout? Will you keep the current owners on or not? Or will you allow the current owners to sell out over time? Are you going to try and share risk by using strategies such as earnouts? We talked a little bit about earnouts before. Earnouts can be quite a contentious area, but it's super important for you as an acquirer to understand how earnouts can work in your different industries. So different industries have different sort of standards in relation to how that can work. But it's also important then that that's backed up, obviously, properly from a contractual and a legal perspective. And then we've got a really important distinction between the acquisition of shares versus the acquisition of business assets. So as you can see, there's a lot for you to consider, but you really need to have your head around what some of these options are before you're even going in and trying to strike a deal, because it can impact the way that you might make your offer in relation to how the deal will ultimately look. Yeah, sorry, go for it, Nick.
No, sorry, Joanna. I was just going to add.
Simon.
Yeah, I was just going to add. It's not just from a legal perspective, but it's also tax perspectives. Some of these options will have pretty big impacts on those as well.
Yeah, absolutely, absolutely. And then, look, I'm not going to talk. The next slide is really as we're talking about the phases of a contract, and I really think that's better talked about in a future webinar. So we'll come back to this. We'll come back to this if you're really interested in that, understanding how this all flows together and what processes are run at what time. And very finally, my very last note is all about the key critical importance of having an eye on how you're going to integrate, how are you going to transition this business post-acquisition. You need to be thinking about that. You need to understand that before you even start, because this is where deals, can really be won or lost at the end of the day in terms of the value that you're pulling out of an acquisition. So there's a lot of things that you need to think about. You need to think about the strategy, but the people and the process and how you execute it at the end of the day. So look, that's it. Sorry, it was a bit of a rush at the end. We had just so much information to pass on to you. As I said, if you're interested in finding out more, we'll run more of these into the future. If you haven't already, I highly recommend you subscribe to the Deal Room podcast. I've just heard along the grapevine that it's the podcast to be listening to in this space. And of course, if you need any legal assistance, then me and our fabulous team of legal eagles here at Aspect Legal are ready and able to assist you as you build yourself up and get ready for an acquisition. You can find us at aspectlegal.com.au, or just throw me an email if you want to get in contact with me personally. And guys, Simon and Nick, how do our attendees get in contact with both of you?
Yeah, look, on the screen there, we have we've created a little quiz for business acquisitions, and you can run through that quiz. That will give us a really good idea of whether you are, how are you placed, to purchase a business. So jump on there or contact us directly via the link on the page.
And I think we'll send that link out there just in case people, aren't good at remembering those kind of addresses. But we'll send that out in an email as well. So if you want to take that quiz and just understand your positioning, we'll make it easy for you.
Yeah.
Finally, look, if you'd like some help in discussing potential acquisitions, we do have also a form which we'll make available that will allow you to create a buyer profile basically and put in some selections. So if you're interested in seeing opportunities, we can try to forward things that are relevant to you. But really what I would also suggest is I think a lot of people want to get their head around the strategy and how to approach this type of thing. There's a lot of decisions to make. So if you would like to reach out and have a no-nonsense chat about that type of stuff, or you've got my email there, or by all means, give us a call, or, just hit us up on the website, and we'd be happy to book something in.
Brilliant. Well, we just want to say an absolutely massive thank you for coming along. It's amazing. We've run over time, which we apologise for, but as we said, there was just so much we wanted to impart on you. And so many of you have made it all the way through to the end. So as you said, we'll be sending you some information after the end of this webinar. We'll send you a survey, and then please let us know what you'd like to hear more about, and we'll look to make sure we can provide some future information for you all. Wonderful. Well, thank you. Thanks, Simon and Nick.
Thank you.
Thanks for having us.
Joe.
Great to be here.
Wonderful. Great. Okay. Thanks all. We'll be in contact.